Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you so much for joining us here. We sure have had a lot to cover the last several weeks, and so appreciate you hopping on here. We just want to stay on top of the developments and give you what we think is the most important. And this week, we're going to talk about bond volatility. So the stock volatility got everybody's attention. It always does, but the bond market volatility is not to be left out here. We'll unpack that and tell you a couple of things that might mean. And then Andrew, this is just a teaser. Andrew's going to share what I think is one of the most important charts of all of finance.
No pressure.
No pressure at all, but it's just from the things that we hear and internal reminders. So that's just a little bit of teaser. If you hang through my part, you're going to get what I think is one of those fundamental lessons in investing. So let's get my part out of the way. We'll jump into bond volatility. So like we said, stock volatility has just been insane, but it's been that way on the bond side as well. We got two charts here I want to unpack for you. The top panel is the MOVE index. So you might have heard about the VIX, which is the volatility index for stocks, but there's also one for bonds, and that is the MOVE index. And you can see it goes up and it goes down over time. Usually it stays pretty quiet, but ever since we had 2021, where interest rates began to shoot up, we've had generally elevated bond volatility, but that had quieted down, and that spiked with a vengeance last week back to 132, which until before that 2021 era, the COVID crash of 2020 was the only period where we saw in recent history levels that high. So we're seeing that high. That does present opportunity. That I'll kind of spare you with the bond math on there, but when we see this sort of opportunity, traditionally we can find instruments that capitalize on this volatility, and you can become sellers of it, which can be quite lucrative. The bottom part is the 10-year Treasury, and the significance here is that the initial part of the stock turmoil, so late March, early April, what we saw was a bond market that drew in a lot of buyers, and that pushed yields down. So as we continue to see equity weakness, yields were beginning to decline. That spun on its head last Monday. Where we really started to work ourselves down coming out of the weekend. And then we had a really wild, something we've only seen 3 times in history, to be down at one point in time, 12.5 basis points, and then close up 12.5 basis points. All that to say, that really changed the dynamics and very well fed the administration's reversal policy on its tariffs. While they were seeing lower bond yields, I think that was impetus to keep them in the game. But the bonds really said, hey, we really got to change direction here. So yields have settled down now, but just wanted to keep you updated on that bond market. You see a lot of trade activity in your accounts. We know that, and a lot of that is on the fixed income side. The more volatility we see here, the more trade activity that generally produces in your accounts as well. So as promised, I'm going to turn over to Andrew to something I think everybody should be very well of and keep burned in their brain. So over to you.
All right, thank you, Adam. I'm going to try to hit that high bar Adam just set for me. So one question that we've often been asked by a lot of the families and by our advisors as well is we start presenting a lot of different data talking about maybe we could possibly start seeing an economic slowdown. We see all the headlines about the tariffs and the implications they can have. We see headlines about the jobs, the labor market, our jobs growth starting to slow, and on and on. And we can start to piece together that there's potential, and nothing's a sure thing, but there's potential that we could be moving more into a slower economic period. Whether it gets classified as a recession or not is less of our concern, as that often happens after the fact. But what's important is when we start seeing corporate earnings begin to decline, and people say, well, what's the point of being invested during those times? If companies are making less money or their growth is not as fast, then that obviously must not be great for the stock market, right? Well, that's when we say, let's look at the data and see what the data says. And this is the chart that Adam was really trying to hype up and show. And it's looking at all the prior bear markets going back to 1950 and looking at the top panel, we have the average move within the S&P 500. What has the equity index done during bear markets? As you can expect, that the days before it starts to decline, sees a variability of decline, whether 10, 20, 30, 40, what have you percent, and then we see a low, and then things start to move higher. What's interesting and what makes this so impactful is the bottom panel, which is looking at S&P earnings during previous time periods. And what stands out is if we notice that when we see the equity market bottom, that first dotted red line, we can see that earnings actually continue to either move lower or they begin to chop around and kind of be stagnant. But often we don't see a final low in earnings until many days later, sometimes a year later. On average, it's about 200 days later do we actually see earnings bottom. And the same type of chart could be shown if we put up there on economic data or GDP growth, that we typically see the stock market bottom before we start seeing a lot of the hard data find a low. And part of the reason for this, well, we don't get overly concerned with the whys, but one of the reasons why we could attribute that is the stock market is often forward looking. It begins to digest the expectation that we're going to see lower GDP numbers or we're going to see earnings contract. And so it processes that information. Traders begin to incorporate that into their models and their allocations well before the data actually begins to reflect it. And so by the time that data gets incorporated, it becomes old news while it's still actually playing out in the economic land or in actual corporate earnings. And then as it starts looking forward, realizing that things may not be as bleak or as bad forever, it starts to rise and move higher, all while earnings are still being gyrating, still being whipsawed around and worked through till they find a low. And so while this is important now, is while we're looking at a time where tariffs likely are going to have an impact on corporate earnings, to recognize that they are separate things from the overall stock market and the prices that traders and investors are buying and selling at, as they are reflecting what's possibly coming in the future. And so we started seeing the market be able to process the tariffs now before they actually got implemented, because again, it's forward looking. And so why do we think this is important is recognizing that if we do continue to see headlines about economic growth or corporate earnings, to recognize that that doesn't necessarily mean it's a bad time to still have some equity exposure, or the fact that equities could actually rally while some of that negative headline gets processed through the balance sheets of different corporations or through the economic data reported every month. And so we always want to recognize what's the market focusing on now. And that's where we start to key off of with allocations or looking for investment opportunities and different ways to structure an investment portfolio.
Yeah, thank you. And I never hesitate to set that high bar. I know you would hit that note, just like a seasoned performer. You're going to hit it every time. So well done. Thank you, and thank you to all of you for giving us your time. If we can be of service, don't hesitate to reach out, 800-928-4001, or scan the QR code and do so electronically. Thanks, and have a great weekend.